As earnings season starts to wind down, investors will turn to the next key inflation reading, with July CPI set to be released this Thursday. For more on what this means for markets, we want to welcome in Jeff Klingelhofer, Thornburg Investment Management, co-head of investments. So let's dive into, first I just want to get a broad take on, we had some talk last week about recession calls and starting to wind down those calls. Do you think the market is assessing that right?
From my perspective, I'm concerned they're really not, right? What we've seen year to date is investors just continue to push their expectations of when that recession ultimately hits further and further out the spectrum. From my seat, I think thus far what we've seen is it's moving in exactly the playbook that you would expect. It's just taking a longer time. And so at this point, I worry that investors are just getting a little too complacent, right? They're not pricing in the inevitable, in my opinion, that we are going to get to the end place, and that is a recession. Now, it is taking longer, but still, now's the time to be paring back and playing a little bit more defense, setting yourself up for that.
And Jeff, what if in the meantime, rates simply go up one more time? You had the 10-year threatening to break up. Let's say it goes to 5%. Let's say the short end goes to 6%. What happens then?
Gosh, if we get to 6%, I think it's going to be incredibly, incredibly tough. But again, all of this is just playing out exactly as you would expect. As rates have risen, that has caused everybody, whether that be the consumer, whether that be the corporation, whether it be our fiscal authorities, we have to pare back spending, right? And so the higher it goes, the harder it gets. But from my seat, most of the market is debating whether we get one or maybe two more hikes. Mm-hmm. Really what we need to focus is on the first 500 basis points that we already have in the bag, right? The ending point to me isn't really what matters. The pain is already there, and it's causing everybody to simply have to pull back, slow down spending, and that begins that march towards the slowdown and the recession.
Are you concerned the Fed is not done?
I don't think the Fed is done, but I think that they're basically done. In other words, my expectation is we have one more rate hike, right? So I think that we'll see that in September. I think that we'll be well set up. And at that point, there's just going to be the continuation of what we've already seen today. It becomes a question of not how far do we hike, but how long do we stay on hold? And again, markets are expecting that once we get to that destination, we immediately reverse course. I don't think that's what we're likely to get.
Well, let's paint a picture for the audience. Everyone is colored maybe disproportionately by their first bear market. So I came up during the global financial crisis, and I remember what things were like back then. But things are different now. When the Fed starts cutting rates, a lot of times it just does it wholesale. We're talking 400 or 500 basis points at a time in a very short period of time. And that's nothing like what the market is pricing in. Yet that's kind of the norm. What do you think about what expectations and their alignment with reality are right now?
I think they're pretty far off, and I think you're exactly right. The Fed usually doesn't start cutting rates until we are actively in a recession. And I think one of the challenges that we have today is the market is saying we might avoid a recession and the Fed will proactively cut rates. I've talked a lot about the Fed used to be a proactive central bank. To me, now they're becoming a reactive central bank, right? We saw it on the way up. It wasn't just when we got inflation above 2%. They had to think it was going to stay there before they started raising rates. I think the exact same happens on the way down. We have to be below 2%, and they have to worry we're going to stay there, and that only happens in a recession. So I think they cut aggressively, but not until we're in a recession.
And one of the things I know that you're concerned about is the consumer, and just fresh data out on the consumer and consumer credit levels. Some data that I am seeing right now showing consumer credit rose by $17.9 billion. That's higher than it was expected. What does that say to you about the state of the consumer?
I think it says it can paint different pictures, but to me, it paints a picture of the consumer that's having to borrow to continue to fund yesterday's lifestyle. Right? As rates have risen, it causes everybody to have to pare back their spending, and consumers are having to tap what is that excess stimulus, that excess savings that's now going away. So I think this is classic consumer behavior. You're broadly seeing, especially the low end of the consumer, having to resort to credit cards and other forms of loans to continue to spend, but that will come to an end, and we're seeing that with every bank survey data out there, right? They're paring back their own loan books, and it's getting tougher for consumers to continue to pull forward demand.
Jeff, keeping with this thought here, what happens Well, let's just take a typical scenario. Consumer credit, you get a little bit of a crunch, lending standards go up, people don't have as much money in savings. That can create a vicious cycle, but it doesn't always end in recession. You take a look at 2015, maybe even 2018 in certain respects. We haven't seen this really hit the pocketbook of Americans. Even the pandemic was just its own animal and outlier. How should people be thinking about what's happening now? What's the tipping point where this becomes a recession problem versus just a balance sheet problem, maybe?
And that really is the million-dollar question. And so we came into the start of the year, we being the market, expecting that we'd already be in a recession as we sit here today. And we're not. And it's because of the strength of that consumer. But as we're watching the strength of that consumer really begin to pare down, at this point, we're only normalizing, right? We're coming off incredible strength of the consumer. We're just normalizing. So the question really is, where are we heading? But again, to me, all signs point to that consumer is continuing to pull back. I do think that leads to a recession. We are seeing companies' hiring plans begin to pull back as well, right? So it's playing out almost exactly as we expected, just under a longer time frame than perhaps we expected.
So speaking of the longer time frame, we know those student loan payments are resuming this fall. Is the time frame that you're concerned about, for instance, in the fall or further out now?
For me, it's further out. So you're right, the student loan payments, they're slated to begin later this year, but there's a 12-month window that you get to step back into them. So really our base case at this point is a recession in the first half of 2024, probably even the first quarter of 2024, and we're starting to see the signs of that poke up even today. One of the things that we're watching with the consumer in particular is the roll rate from 30-day delinquent to 60 days delinquent. Right? That's where you go from, gosh, I missed a payment, I forgot, to I never intended to make it at all. We're seeing that tick up, and that's a little bit of a concerning sign. But again, we're seeing it mostly pick up via the lower quality subprime consumer.
Makes sense. Something to keep an eye on. While we still have you here, and we got a few minutes, want to get to some of your stock picks and what you like here. You're advising a barbell approach with high quality fixed income, and you got a couple tickers you want to talk about too.
Yeah, I think especially from the fixed income side, right? Yield is back, right? Income is back within fixed income, and that is a very different paradigm than we're used to in the world of fixed income. That inverted yield curve sets up an environment where you can build a very high quality portfolio and you don't have to take a lot of risk. So within fixed income, we're focused on very acyclically oriented companies. We're focused more short on the duration spectrum, taking advantage of that inverted yield curve. I would say on the stock side, we like some of the acyclical picks. So CME Group is something we've talked about. We think they're under earning. It's the world's largest derivative exchange, and it benefits from rising volatility. So again, as volatility picks up, their earnings pick up, and it's an interesting pick from our perspective.
And what would you say, given just this barbell approach, what would you say that you're steering clear of in terms of how you're positioning or advising to position your portfolio?
Yeah, as we're talking to clients today, right now is the time to be putting your portfolio in a very defensive position because you're not having to give up those future returns in order to do that. And so the thing today, right now, is focusing on defense and being ready and nimble when the tide does turn.
All right, we're going to keep it there. But really appreciate you stopping by and all your insights. Jeff Klingelhofer, Thornburg Investment Management Co-Head of Investments.